The next Fed meeting happens in May, and in today's market movers, the traders are already setting up with easy-to-follow futures and options trades from CME Group.
Welcome to Market Movers. I'm Jim Urio, and we're a couple days away from another FOMC meeting. Now, the Fed has talked aggressively regarding raising rates, and the stock market hasn't seemed to like it very much. We're looking at using 10-year T-note options to either hedge risk or create opportunities surrounding this Fed meeting. Joining me is Chief Investment Officer of Kingsview Asset Management, Scott Martin.
Hi, Jim.
Okay, so what the market says overwhelmingly that at this meeting, no hike, but at the June meeting, hike, like 90% in each one. What could be the surprise at this meeting?
So you're telling me there's a chance
they're going to get... there's a chance.
Yeah, about 1 in a million. Look, Jim, you know what's interesting about this? It probably doesn't matter so much, actually, what happens next week. Even if they were to hike, we know they're not going to, as you pointed out. But what to me matters is the language in that meeting and what they come out and say about how the market has been reacting to these higher rates, how maybe they're going to react to softer economic data going forward, which we've started to see recently.
Are you implying for a second that the weakness in the stock market, the volatility in the stock market may have gone into the Fed's head and they might be a little scared to be hawkish?
I'd be implying that for more than just 1 second, my friend, because I believe that's one of the things that the market is still trying to figure out here, Jim, is if the market gets volatile, if it gets some pressure, does the Fed respond?
Yeah, no question. And we've complained about them in the past because they do seem to respond too much to asset prices, but we all know there's a level that they would have to respond. It's probably not 9%.
And if they don't respond, then that's going to be a major adjustment period for the ES, the NQs, and all those equity indexes out there.
Now, before we dive into our trade discussions, I'd like to point out that as with all market movers, it's important to view these as examples that allow you to see different ways to use futures and options products to either manage risk or create additional trade opportunities, not as recommendations or advice. Prices and movements will vary in the markets. The underlying, the June 10-year was 119.02 when we priced these out, Scott.
So here's what's something interesting about the ZN lately, Jim. I mean, this is one of those ones that you saw coming for many, many months, right? I mean, it was obvious that rates were going to go up, and whether they're going to go up faster on the long end or faster on the short end, we've obviously seen what's happened. But that was really the only question that was left to me is where was that big interest rate move going to be? Because it was coming. And so specifically, Jim, actually, though, I think there's an interesting opportunity here to maybe pull back the anticipation of all these interest rate hikes and see what we can do as far as maybe find some value on the other side of interest rate hikes, right? So today specifically, Jim, looking at the 119.5, 120 call spread. It costs you about 10 ticks to put on. Expires May 25th. The underlying, as you mentioned, is just a skosh over 119. It risks 156 to make potential 344. Because if you look at the move in the ZN and just say the last few weeks, all you need to do that's right. And all you need to do is maybe retrace 40, 50% of that move to see that call spread fill out. I believe that's a favorable risk-reward opportunity.
Funny you should mention that, because I'm looking at something quite similar. Yours expires May 25th, and you're paying 10 ticks for the 19.5. 20.
Yep.
Now, I'm looking at buying the week 2, which expires May 11th, so 2 weeks shorter, the 119.25, 119.75 for 11 ticks. So basically the same price as yours. Again, it expires 2 weeks earlier, but you get a quarter tick lower on the call spread, and you risk 172 to make a potential 328. What do you think of that?
I like it. And I mean, the only thing that worries me a little bit is this should have, I believe this is one expression where it's just an overreaction that we're taking advantage of, right? In the sense of we've just seen the ZN just get absolutely smoked as rates have gone up. So the only thing I would tell you is, while this looks like something that at least as far as the risk reward is attractive, I just like having the time on my side on my expression, because of the fact that it could take the market a few extra weeks to just come to its druthers and figure out, you know what, we freaked out about all these interest rate hikes that may or may not come.
I can't disagree with you on that. I like your trade quite a bit. Thank you for joining us on Market Movers. I'm Jim Urio, where we're helping to make you a better trader.
Check out businessfirstam.com to find out where to see our entire show. And don't forget to like, follow, and share Business First AM.